How did the world's best investor, Warren Buffett, produce a 20% return per year for 56 years through a wonderfully simple investing strategy that we could all learn from and apply ourselves? Today, we're going to go through all the things he looks for in companies that could increase your likelihood of success when investing in stocks. Hi, I'm Marcus De Silva and welcome to the Steps to Investing YouTube show, helping you beat low interest rates with simple tutorials and strategies that get you investing in the stock markets and earning a better return. Please like the video and subscribe to the channel and turn on notifications. We release new videos every Monday. Also, send us an email if you've any questions. We have a whole network of experts that can assist. Okay, today we're going to have a look at the big man himself, Warren Buffett. He's the world's best known investor. He's amassed a personal fortune of over $100 billion through his investment holding company, Berkshire Hathaway. As is often the case with genius, his principles are actually pretty simple, and it enables you to find well-run, financially sound businesses for reasonable prices, which increase your likelihood of success when you're investing. He has been incredibly disciplined with this approach over the years, and because of that, it steered him around disasters like the dot-com bubble, and of course made him very rich. His approach is what they call value investing. It's the oldest known style of investing in the world and one that is pretty tried and tested and used by many professional investors across the industry. So we're going to have a look at what we mean by value investing and then drill down into 4 principles that Warren has tacked on to this approach to select high quality companies. At the end, we've also got some extra tips for smart investing in general, plus an essential book that every value investor needs to read to master this style. So stick around for that. All right, so who is this guy? Well, in short, Warren Buffett is the best investor that has ever lived. Through his investment company, Berkshire Hathaway, as I said, which he bought back in 1965, he's been buying these large controlling stakes in businesses for 56 years and has managed to turn the share price from $19 per share into $428,000 per share, which means if you put £1,000 into his company back in 1965, you'd have £22 million today. Now, the key to his success was meeting this chap called Benjamin Graham all the way back in the 50s when he was studying at Columbia University in New York. This guy, Benjamin Graham, was a pioneer in creating the modern investor. He came up with this concept of assigning a value to a company so that he would know if its share price was cheap or expensive. If its share price was significantly below the value he thought the company should be, in other words, it was really cheap, then this was the basis to invest. All you have to do is wait for all the other investors out there to agree and for the share price to rise. Buffett then added some genius additions to find not just cheap companies, but cheap companies that were also really decent companies. Let's have a look at how you might value a company and then what Warren looked for to determine if it was a good company. Please don't forget to like the video and subscribe if you're enjoying it. Okay, let's get onto this concept of value investing. If you know how valuable something is, you can tell if its price is cheap. Everyday stuff is easy. If you saw a flight to New York for 60 quid, you would know that it was good value, right? So how do you look at a share price and determine if that is a good price to pay for a share in a particular company? This is a little bit trickier, but it's a process that investor Benjamin Graham formulated many years ago. Mr. Graham came up with this idea of intrinsic value, an analytical process of sifting through all the company's finances, things like its sales, its profits, its debt, its assets, as well as looking at other factors that were quite fundamental to the business, like its brand or its business model and its marketplace, to figure out how much a company is worth, its true worth, its intrinsic value. He then said, whilst this is ultimately what influences the share price over the long term, over the short term, there's a whole load of extra factors that play a part in determining what a share price is. A crisis is actually a good example, right? People panic and they just sell shares regardless of whether the company is doing really well. This is why one of Graham's famous observations was this: over the short term, the market is a voting machine, but over the long term, it's a weighing machine. If you stick around to the end, I'm going to share his famous book that became what is really the Bible of the investing world. Now back to Graham, he didn't really care about great companies. He was fine with mediocre ones, as long as they were very, very cheap. Buffett, who was convinced later by his long-term partner at Berkshire, a guy called Charlie Munger, wanted to find great companies. His view was this: it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Now, Buffett had some guiding principles which told him if a company was good quality or not. And over the years, observers have distilled them down into some simple criteria which we can use. Let's have a look at 4 of them. Okay, number 1, know what the business does well. Buffett really likes to understand the businesses that he invests in very well, which means knowing all aspects of it and the marketplace they operate in. He also likes ones that aren't overly complex. It's why he's tended to avoid tech over the years. If they're complex and they make money in really obscure ways, it becomes hard to predict how they'll make money into the future and therefore what drives their success. To give you an example of some of the simple stuff that Buffett has invested in: Coca-Cola, American Express, Bank of America, and Duracell. Again, there's a famous quote: invest in the companies that an idiot could run, because one day they will do. All right, number 2, make sure the business has an economic moat. So Buffett likes businesses with barriers that protect it against competition, and he calls this their economic moat. So could you go out and replicate an iPhone that easily, or build a payment network like Visa has, or a brand that is as globally well recognized as Coca-Cola? Branson learned that lesson the hard way actually when he tried to compete with Coke and launched Virgin Cola, which failed spectacularly. These advantages protect the business's position in its market and therefore its profits. Much like a castle, it entrenches the business and fends off attacks from its competition. All right, number 3, as you'd expect, he looks for solid finances. So Warren's genius means it's impossible to know exactly what he looks for when he roots through a company's financials, but there are some core tenets that we can learn from. Hilariously, he still does this by hand and with paper copies of the annual report, and he says he only uses his computer to play bridge. Anyway, nonetheless, there are 3 main things really that he looks for: that a business has high profit margins, and preferably that these profit margins are rising, as this shows that management are good and they're keeping a tight control over the costs of the business. The second thing is that he doesn't like businesses that are loaded with debt. If you have massive interest payments and debt repayments, and suddenly something happens to your revenues, like during COVID, then the business could much more easily tip into bankruptcy. Third thing that he looks for is that a company invests its money well. Now, Amazon is a good example here. Its profit margins aren't very high because it's in retail, but its investments produced 20% returns a year, and Wazza loved them for this. All right, number 4, patience is a virtue. Warren really believes that investing is a long-term game, and I definitely agree with that, because it's where compounding really comes into play. Indeed, he was quoted as saying, if you're not willing to own a stock for 10 years, then don't even think about owning it for 10 minutes. Anything that's flashy or faddy or fizzly won't be around that long. It's the steady eddies that win the race, slowly building good returns upon good returns over many years. It's how Warren ended up so darn rich. It wasn't overnight. And for these reasons, he avoided .com and the mania and ended up on top, even though many people criticized him a lot at the time. That said, you still need to keep an eye on your investments. And if it gets to the point where you think they run pretty hard and are looking overvalued, or something has changed, right, with a business model or management or something that makes the stock less attractive, then you can start to sell them down. Remember, you don't need to sell the whole lot all at once. You can actually just trim out of that particular position. Okay, as promised, here is an extra tip from the big man himself on investing in general. Keep cash on hand. Warren has gone long periods of time keeping cash in Berkshire, having not quite found the right thing to invest in. In truth, he's probably got a few stocks that fit his quality criteria, but they were just too expensive at that time. If you have cash, you have the ability to pounce when prices go down or even crash out during crises. When markets panic, buy, buy, buy. During crises, markets tend to throw the baby out with the bathwater, and it's where real bargains can emerge. Okay, as promised, in the bio we have a link to the #1 book on investing. It's called The Intelligent Investor by Benjamin Graham. It's not the easiest read. It was written in 1949, but it has stood the test of time, and it's highly relevant today. And every single professional investor starts with this book. The link is for Amazon. It's not that expensive, so give it a crack if you're interested in value investing. All right, in summary, Warren Buffett is this legendary investor who has managed to return on average 20% per year for 56 years. His style is value investing, so finding stocks that are trading below the company's true worth. He added to this the idea of only investing in high quality businesses. And the things that he looks for is simple, predictable businesses with solid finances that can protect their profits through clever business models. Thanks very much for watching. Don't forget there is stepstoinvesting.com for more education and information. We'll see you next time.